reach out if you need
Okay,
anything.
here we go. Okay, I'm watching something load. Now we're live. Hi, everyone. Welcome to our panel, How to Value a Cannabis Company. I'm Barbara Webb, and I'll be your moderator. I'm a director of tax and the co-founder of the Midwest office of MGO LLP, which is a national public accounting and professional services firm that became active in the cannabis space very early on in California and the Western states. My own clients include all sizes of cannabis companies, from startups to publicly traded. So I've pretty much seen the full business life cycle in this industry, at least up to where we are today. Before we get started, I want to thank our sponsors for the Grown in Cannabis and Capital Summit, law firm Michael Best, Verita Innovations, free marketplace and delivery management, Debt Capital Consultants, seed sale funding, hi Judy, design build firm Cannabis Facility Construction, payroll, recruiting, and HR administration firm Illinois Equity Staffing, and my firm, MGO LLP. Also, I'd like to remind you that we have special learning pages with links to documents and other items pertinent to this discussion on the Grown In learning pages. So check out grownin.com/summit-learning. Finally, we're conducting a chat throughout the panel and gathering questions. Grown In's Eric Davis is moderating the chat. Hi, Eric. Hope you're out there. And I'll be gathering your questions to the extent I am able in the Q&A section to address at the end of the panel if we have some time. Today's panelists are Jeff Matthews, Managing Director of Acro Capital, LLC. Jeff has been an investment banker for over 20 years and is a founding member of Acro Capital's cannabis practice. He's advised on a wide range of cannabis companies with private capital raises, strategic mergers and acquisitions, and the like. We also have Brian Schinderly, Managing Director of Solidum Capital Advisors, LLC. Solidum invests both its own capital as well as working in partnership with family offices, high net worth individuals, and non-traditional sources of capital. Some of you may know him best for his role as Executive Vice President Finance of Grassroots, a post he held from mid-2018 through September 2020. And we also have with us Fernando Russo, Vice President at Young America Capital, where he works with clients in the cannabis industry, advising on and facilitating equity, debt, and M&A deals. Welcome, everyone.
Thank you.
So let's embark on our journey into the world of cannabis valuation and vicariously experience the thrill of victory and the agony of defeat. Cannabis company owners and execs want to know the why, the how, and the future of their valuations. Cannabis investors are interested, of course, in those questions, and the question, which one? What is behind the valuation I'm putting my capital behind? So let's get started with some of the most knowledgeable, experienced folks in this business who also help shape the answers to these questions. So Jeff, I'm going to give you the first question. How is this panel on valuation and this topic different from the one we just heard on venture capital?
So I think what we'll try and cover, and people should feel free to chat us and if we're not answering questions, but is going a little bit more on the actual valuation. Some of the previous panel was, I think, more about how venture capitalists, may look at valuation or may look at investment opportunities. And so I think our panel is meant more for giving you the tools for looking at your own valuation, as well as how you can improve your valuation going forward, and what you may do to ultimately attract either capital or have a successful exit opportunity.
Brian, any other thoughts on the difference between, I know they're very close, but folks who are working on the VC side and those crunching the numbers in the valuation side? Oh, I think you might be muted.
You're right, I was.
There you go.
You're seeing a tremendous amount of activity right now on the M&A side, and as opposed to VC, which tends to be either very early stage or possibly round A. I think you're seeing a lot more interest in how to put valuations and how to put relative valuations, because everyone's looking at their screens, and the of course the public equities are flying, and both on the northern side of the border and in the U.S. And everyone would like to dream and think about what that might infer for their valuation, but a lot of differences between the size of companies, the point in their development, whether or not they're EBITDA positive, whereas VC very different in looking at probably connecting dots as to where the company might be 2 years from now and a path toward when they break through and how to value it. So I look at this discussion as meaningfully different from that perspective.
All right. And when we get into the valuation world, the sellers or the those looking for investment capital want their valuation as high as possible. Investors are looking for some upside. Fernando, what are some of the common disconnects between those two worlds of the seller operator and the buyers and buyer bankers or investors?
I think Brian touched a phenomenal point there. We're seeing the publics flying high as they've been. So maybe entrepreneurs or decent operators, lower middle market, multi-state operators, single state operators go to Yahoo Finance and see what is happening. And then they believe, well, if I thought my valuation was 20, I think that today, just because of that, is 30. I think that's the disconnect between the reality of deals being done and what the market is telling. And I also try to remind, Cresco, Truly, Tilray, they all enjoy those valuations because they're publicly traded and liquid, right? You can go in and you can go out. So they present a better investment opportunity. When you invest in a smaller company, you lock up your capital, in some cases with a clear exit strategy, but some cases don't. So I think the disconnect is all this noise and the reality of the small, medium businesses that we work with.
But given that we have this is a new-ish industry and we have so few benchmarks for valuation that are exactly or even very, very similar to the same space, we do usually have to look to the public companies as some sort of baseline. Jeff, what do you think? Why do you agree with that reason for why we have to look to the public companies, and what are some of the limitations in the end of that benchmark?
So I think some of what's unique to this sector versus maybe technology or some of the other startup markets is when you're looking to the public markets and some of the companies, there's roughly around $15 billion public companies. A lot of those companies have a very defined growth path, so they can project a 50+% growth and do it with assets that they already currently own. So there is no need for a plan that includes something that you currently don't have. And so I think that creates part of this disconnect, and why public market companies, in addition to what Fernando mentioned, are valued a little bit higher, is that a company like Trulieve or GTI or a lot of the companies we know, they can point to the 10 or 15 retail licenses they already have and have dispensaries under construction, or another 10,000, or just the fact that they have a license to grow in a state like Illinois, where you're going to likely have production shortfalls. And so they can project that extra 10, 20, 50 million of revenue that they'll achieve, which also then provides scale, generally are going to be higher margins as well. So that creates a little bit. Now, I think the disconnect is pretty vast. Many of the companies are, let's call it 7 to 10 times revenue or 20+ times EBITDA. And private companies are getting a significant discount to that. So there's probably going to be a little bit narrowing of that over time, or should be, for some of these companies looking to raise capital.
So when you're valuing a company that is not public, we have the benchmark of the public companies, but we have to use something else that's maybe more appropriate to the size of the companies that are being valued that are not public. I know that when I speak to new cannabis businesses, especially cultivators, we emphasize tracking your cost inputs, tracking different strains, understanding what's profitable for you. But Brian, what are some other metrics that you place a lot of value on when you're valuing a cannabis company or assessing the value of a cannabis company that is not public and not really on the verge of quite going public? Maybe it's an acquisition target or a mid-size.
I would say a few things. Really, the quality of the asset base is quite important. You know, I've probably been in 80 or 100 grow facilities now, and the puzzle that I had tremendous value on evaluating. But I can tell pretty quickly, you know, whether or not something was put together very thoughtfully, and whether they underspent on CapEx, or they really, you know, have done it the right way.
Now, is that an intuitive assessment? Are you saying there's a little? Is that outside the math, or you just know what variables to pick for the math?
I think, look, I think there's some, you know, some things are somewhat obvious, right? If you're some facilities were not well suited for grow rooms, and people stuffed grow rooms in there anyway. And then other, you know, facilities, you know, you can tell they really, you know, had very, you know, had a different budget probably, but also had the right people who laid it out and made it work. But look, I think it's quality of assets. I think ultimately it's the, you know, integrity of the operating team and the execution. And I think really, you know, the rare commodity in this space has been, and in many ways continues to be, quality of execution at the management level. It's, you know, it's one thing to apply and win some licenses, and then to, you know, put together some plans and raise some money to build innovation, and we're going to do extraction. We're going to, you know, throw some brands out there. But executing on all that and doing that successfully is very impressive when you see it in real life, and it typically shows itself in the numbers. And, you know, that's where you see it in margins, you see it in, you know, EBITDA, you see it in cost controls. And, you know, increasingly that type of professional management will equate to winners and losers, which will be valued accordingly.
Right. Growing weed is not easy. It's not, I have a license and poof, I'm a profitable cannabis company. Fernando, if you're
everybody thinks it's a very easy thing to do, right? Everybody thinks it's very, hey, we're in square feet, we're going to plant weed, and it's going to be fire. It's going to be the best stuff ever. And we hired some master grower who used to grow in Colorado or California, and he's been advising us. And, you know, we don't know how to grow weed. We're just incredible, and it's going to be great. And, you know, so it's tough. That's why it's, you know, it's very difficult to value early stage companies as a result of that, because there's just so much execution risk.
So not easy. We'll put that on. Just put that out there. Fernando, if you're going to crunch some numbers. If you're going to go beyond looking at the management and you're going to sit down with your pencil and your green eye shade and crunch some numbers, what are you looking at?
I think assets are limited into what they can produce. If we look at a cultivation facility in Massachusetts or limited license states, the fluctuations of the wholesale price of flower can go up and down, improve revenue. You can get better with EBITDA by improving operations and using new technology. So I'm a big believer on cash flow, and I'm a big believer of analyzing the potential of these assets. For example, a dispensary is limited to what they can do. They can go up and down, but we know we can have an idea of what that bottom line looks like. And what we're seeing today, at least with the family offices and private equity type of groups that we work at, that matters, right? That matters a lot. So we like to look at that number when it's a limited asset, let's say a cultivation facility or a dispensary that can scale beyond what they're doing. Now, I think the real value, and when we're seeing the fun stuff, is with intellectual property. Brands are starting to matter a lot. Trademarks, processes, things that make a company special. But in terms of intellectual property and brands, I think that's what can really scale and what we can apply a growth path and maybe a discounted cash flow model. Because you have a great brand in California, you can do licensing, you can bring it to other states. So to recap, for fixed assets, I like to look at what can you produce and how is the price going to fluctuate and affect your revenue, and try to project that EBITDA and work with that number. And with the intellectual property, maybe get a little bit more creative and apply multiples that would imply, you know, scalability to a point that these brands and these assets and these companies can enjoy phenomenal growth.
Do you think there seems to still be an element of risk, though, when you're looking at brand trajectory, given that we lack interstate commerce right now, and something that's been a huge hit in San Diego might not necessarily be a huge hit in Detroit, brand-wise? Jeff, any thoughts on that? Oh, actually, Fernando, go ahead. I asked it to you.
Oh, go ahead, Jeff. Sorry.
No, the challenge you have there, and you're right, is I think that's a two-part. It's one, the ability to scale a brand, or maybe three aspects. Ability to scale a brand. So is it, do you license, or do you, go into a new state and build your own, get licensed and then create that? That's obviously the challenge for most, because it's capital intensive. So I think most brands have gone the route of licensing in general, to one, seed the market. It lowers your capex risk, but it also then, if there is opening of interstate commerce, allows you to then have a brand in that market with a little bit of exposure. I think I think the other challenge is a lot of vertically integrated, or those companies that control the distribution, are creating in-house brands. So I think if you have a brand and you're manufacturing, one thing you have to ask yourself is that what is going to be, just like you would in any other traditional market in CPG, what is your distribution plan? And what's your ability to get on shelves? Because, the in-house brand for a lot of companies, which you may not even know is in-house, most dispensaries are carrying a lot of that product. And then I think finally, it will have an impact, I think, from a interstate commerce for those who can build a brand. I know I'm based in California, and several companies are looking towards interstate commerce to really be the valuation, especially if you're talking about the green triangle and flower. And so I think that layers on just, hey, you're going to leverage a regional brand as a way to scale your value of your business as well. And a lot of companies out here are heavily invested in that being a factor. And so I think it's also, as you're looking at your own, it's the consideration on that. Are you, is your brand a flower brand? Is it a vape pen brand? Is it a gummy brand or other edible brand? And how does regulatory change impact that value? So we look at that as well when we're talking to companies.
It's interesting you mentioned the distribution angle. There was a question in the chat earlier about, I think it was in the special chat room, about the viability as a business model of a distribution only or a transport only. Now, you could be vertically integrated, but I know that in Michigan, independent distributors are maybe a bigger business than they are elsewhere. Brian, what's your view of the role of distribution now or in the future in a company's value? Is there going to be room for independent distributors? Does it depend on the specific state climate? Or in the end, is complete vertical integration going to be the way to go?
Well, California is kind of the ultimate poster child for distribution, because they offer separate distribution licenses, and therefore, you have separate companies that are only in that vertical distribution. That they're in, with the exception of California, and that's pretty typical. And people want to control that point of contact with the customer. And distribution in California is expensive. It can be anywhere from 16 to 20%. And
you're freezing up a little, Brian. I think we're missing some of what you're saying.
Is that any better? Maybe, I don't know.
Yeah. Now I can hear you.
Okay.
I think we missed your last couple sentences, though.
No, well, it's tough. It's with 16 to 20%.
might have to come back to Brian if he unfreezes. Give him another second there. Brian, you're still frozen. When you're unfrozen, we'll come back to you.
I'd like to follow up on Brian as he gets back. One thing that we're advising our clients to do that have this brand or distribution strategy is to separate the plant touching business from the intellectual property business. Because if you're a plant touching company in California, let's say a type 11 licensed distribution, and you have your brands and you want to bring them out of state, we certainly advise to do that if that's the path to scale and bring brands from out of state.
Got it.
And yeah, and another point on that is also the managing of, you can either just license your brand, as Fernando's saying. It also depends if you do have interesting IP, if you will, not that everybody doesn't have their own nano emulsion or that, but if you have some other packaging you can do, a lot of companies are also building kind of, especially in edibles, the edibles market, you build kind of ready to go pack. So you retain as much of the value as possible and you sell that to whomever is going to be your distributor in the different states. And then that way you don't necessarily have to give away as much. You can sell them as much of it as ready to go. And depending on how you manufacture your product, they can just do the infusion at the end. So that's something to keep, to keep in mind as you're figuring out which way to go in terms of branding and increasing your distribution. But Brian was correct in terms of here in California, it can get expensive. So if you are doing distribution anywhere, you need to understand what value you're getting, because I know, and this goes back to understanding, in terms of valuing your company, understanding what your margins are, because obviously if you're utilizing a distributor, that is lowering what your margin is on that particular product, and weighing that against hiring a sales team or having trucks and the logistics behind moving your product around the state. And I know that is a challenge, but understanding that and then having that translate into what your margins are. It's not just, oh, I use a distributor, that's great, I'm getting the same margin as I did when I sold to the 10 locations previously. So making sure you understand that and modeling that out, but it can be valuable because hiring more sales and marketing, can be expensive, because obviously that, impacts until you scale, right?
And logistics is its own specialized skill. I mean, not everybody who's a manufacturer can execute on logistics. So maybe it's worth that extra bite into your margin.
Yes.
Absolutely. Logistics, cash management, reaching out dispensaries, at least in the state. I do a lot of work in California where Jeff is, and it's such a vast state. And, people are maybe more Northern California, maybe Southern California, but in vertically integrated markets where you can do everything, I think it's key on how efficient you are with your assets and how good you are at creating the best bottom line, the best EBITDA possible.
Talking about inputs and EBITDA and cash flow, let's touch on my favorite topic, taxes, 280E. Are you building into your models yet the possibility of cannabis being delisted and no longer being subject to 280E? Or likewise, are you building into models access to banking? Because if a cannabis company has a certain cash flow today based on those assumptions, if both of those variables were to change a year from now, I mean, how long is your valuation valid for? I'm just interested as to whether that's ever built in.
I have a clear example, if I can take this, Jeff. We're working on, we are licensing sellers of a handful of dispensaries pretty much in every state. There's a lot of interest by MSOs and retail. And one of the things that I decided to do last week is to ask a group that I'm working with, talk to their accountant and say, hey, why don't you model the income statement, or why don't you model the financial statements without 280E? Because when you think about it from a business doing the exact same thing, without 280 immediately becomes more profitable, right? So modeling those things and having those ideas and maybe trying to find a better valuation and a better delta with that horizon of saying, this is, I don't have to do anything better. It's just going to get better. Now, when we talk about access to capital, debt is expensive in cannabis. We're talking about mid-teens. So the more capital we access, we'll reduce the cost of capital. We'll pay less to operate for our financing activities, and we're going to become better. Now, are we modeling all those things? Candidly, I would say, because we don't want to get ahead of ourselves, because we still have to see real progress and real movement. I know there's a lot of things going on, but we're definitely starting to have those conversations, Barbara.
So are you telling me that valuation is a pretty conservative endeavor in the end? We don't want to get ahead of ourselves to something that might happen in just 2 years, which seems like a short span of time. And also, I might bring up, I'm wondering if you see a day when we have the public companies and those that can scale. Do you see a day coming, and Jeff, take this one if you want to, when there is a viable middle market valuation model for a mid-sized, say, grow operation or manufacturing operation that produces a specialty product, maybe that can be a legacy company, that the owners and operators are not in this endeavor necessarily to sell in 2 years, but maybe it's more like the family manufacturing model where the business is passed down. I mean, I would guess your metrics completely change at that point.
Yes, I would see that this market will, and I think as some of the regulations change, even from a banking, as you talked about, and getting rid of 280E, that you'll start to get a bigger influx of investors, right? Just a broader audience of investors. As we've seen slowly, we've noticed an increasing amount of people edging their way in, but you would create, just as in other markets, there'd be this big or a bigger universe of private equity firms, of like true private equity firms that see, great, we have an ability to come in. There, you've been, like in other industries, either you want to grow the business a little bit faster, you need some help in some ways, and you want to monetize some of what you've put into the business, and somebody coming in and just like in other industries and, either doing a roll-up strategy. I would see that being something that occurs more frequently as this market matures and some of those middle market companies fall into that. And I think those valuations will reflect that, right? And it will be in that deals that are much more of the cash flow based and looking at that, and maybe even providing a little bit of equity for, owners to retain, management promote, as we, call it in our lingo. But much more of those deals I would see being frequent as people who maybe got one license were able to build something, a cultivation, and somebody come in and say, great, I have one in 3 other states, and maybe they're not attractive again for a MSO at that point, but somebody who can manage operations well, is very good at that, of managing, feels that they can extend the business further. I see those deals happening a lot more once things change a little bit on the regulatory front.
Yep. And I think a lot of craft growers and smaller operations are looking forward to that day. But right now we have sort of this cliff. Brian, welcome back. So I'm going to direct this one to you. Between these sky-high multiples of the public companies and the dreamers that are just starting out, and then the folks in the middle who are underway and they're cash flow positive, but it's probably still not realistic that their multiples are going to even approach the publicly traded companies. So where is that? I don't know if cliff is the right word, but where is the divide? Is it revenues? Is it some measurement of scale? I know it's probably not revenues because we're not supposed to look to that anymore, but what are your thoughts on that? How do we separate these tiers?
Look, I think it is. I think if you just separated it by equity market cap, which we tend to look at, and you look at sort of the $1 billion and above, and then you run the comparables as to what they're trading at as a multiple of this year's revenue, next year's revenue, this year's EBITDA, next year's EBITDA, and you sort of do a composite. You come up with one multiple. You probably step down about 40% when you go to that next tier of equity market cap between, say, 200 million and $1 billion.
And what causes that? What's the driver for that huge step down?
I mean, it's scale. I mean, it's a few different things. I mean, to a certain extent, it's public to private, and there's clearly a step down for public to private. Even if the company is public, institutional investors that are stepping into this space want to buy into scale, and they want to buy into meaningful positive EBITDA. And so the guys that are trading at $1 billion and above typically, meet that profile. They've got less execution risk as far as build outs because the majority of their platform already is built out. Whereas, if you have a $200 million business, many times, we get the deck and they're doing 50 million of EBITDA. I'm sorry, 50 million of revenue, but they think they're going to do 150 million of revenue a year and a half out because they're building out to double capacity. They're bringing online, and doubling the number of dispensaries they have, et cetera. So that all takes time. That all takes a lot of execution. People are not going to give you credit for what you think you can do a year from now. When it's 50% of the total revenue you're showing a year from now, or more. So there's just a natural discounting process, and then also these deals have to be accretive. So if you think of the food chain, the big guys are going to swallow the medium guys. The medium guys are going to swallow the smaller guys as far as industry consolidation and how these roll-ups occur. And if you're trading at 20 times forward EBITDA, then it's pretty easy to make a deal at 8 to 10 times EBITDA look very accretive, and your investors are very excited about that. If you're trading at 12 times EBITDA, forward EBITDA, then you need to have that deal look more like 6 times EBITDA in order for it to make sense, in order for it to be as accretive. And typically those are of scrub numbers, not the numbers in the deck. They're of the numbers that people have stress tested and feel comfortable that they can achieve. So I mean,
so is this partly due to the size of the dollars coming in and the demands of the investors? I'm kind of backing into this. Like if we've got these big institutional investors coming in, we need these multiples, and so those are the firms that are winning the big dollars.
Well, look, it all starts from the top down. I mean, if you were to see all the cannabis stocks, the big guys, GTI, Cresco, et cetera, if they were all to get hit to where they're going, they go from 22 times 2022 EBITDA to 16 times 2022 EBITDA, everything would reprice with it. And that's exactly what you saw in the spring of 2020 when COVID hit, right? The multiples went way down, and that meant private guys were just, the multiples that people were putting on them were very, very low. And makes sense. So to a certain extent, yeah, it does start at the top, and then, you do naturally pay less for a situation where you've got more execution risk to hit the numbers a year to 2 years out, and it's smaller scale, et cetera, unless it's just tremendously special. What they have is
right.
The unicorn company with crazy good genetics or some kind of unique brand platform profile, which you believe is just going to absolutely tremendously kill it within your business. Then people look at that differently, but it's hard to differentiate yourself on those type of metrics.
So those who have the scale get more investment to scale more is kind of the world we're in right now, though we're still holding out for the middle market future that Jeff was talking about. Yep, I hear you. So Fernando, when people bring you a deck, oh, go ahead, somebody.
No, go ahead.
Oh, okay. When owner operators bring you a deck, what do you wish they were doing that you're not seeing as often as you would like?
I think there's maybe for phenomenal operators that are great growers or that can do something great with infused products and have great brands. I think they all lack. I have come across very few middle market companies with a real CFO. So when we started to look at the numbers and we start to look at the performance, we need to put a lot of work into those to even, because as we all know, performers are just that, right? Or a promise or a wish for the future, but they need to be realistic. So I guess that's one of the things that, we can see these beautiful design decks with all these things here and there, but they lack that in-depth financial in explaining to an investor why would you invest today at this enterprise value, and what's the path going forward to take your investment today at X enterprise value to 2x, 3x if the company executes clearly. So a real clear financial roadmap I believe it's essential to any deck, and it doesn't have to be 5 pages, but it has to be at least 1 or 2 slides presenting certain form of performance that makes sense.
So if I'm going to give you $10 million, tell me in detail what you're going to do with that $10 million and create a return.
Yeah, absolutely. And one of the things that we're seeing too is sources of uses of funds. A lot of people lack. I like to see granularity. I like to see to the penny. What are you going to do with the $5 million that we're going to get for you? How are you going to invest it? Don't tell me $1 million for marketing and $1.5 million for no. Tell me how you're going to invest that. Where are you going to spend that? Is it going to be social media? Is it going to be MJ Biss and Hall of Flowers? Is it going to be hiring this top-notch executive summary? So I think those are the pitfalls when we're raising equity that we work a lot with our clients to tell them. A real investor is going to really look into this and see what is their investment going to do for the company, and how is that going to increase the enterprise value and give them a nice exit, or any of the other things that we could see.
So get real with the numbers when you go shopping.
And get real, get down to the penny, and really have a clear roadmap of where that investment is taking you.
Now, we're getting a lot of questions in the chat and in the poll. I think there are many folks in our audience who are interested in how do you value a newly licensed entity? And I suppose that could mean different things. You could be newly licensed and not operational. You could be newly licensed and almost cash flow positive, or you can still be fairly new licensed. You got underway and now you're cash flow positive. Jeff, any thoughts on that?
Yeah, I think, and Brian kind of touched on this, I think, a little bit. A new license, a lot of it will depend on location, and so obviously what that license is it to grow? Is it dispensary? Is it vertical license? So a lot of the valuation will be really based on that in the experiences we've had. If you're a license in Michigan and we've talked about it in a city that already has a significant amount of dispensaries per the population per capita, it's not going to be worth nearly as much as one in a new municipality that doesn't have any dispensaries at all.
So state regulatory environment. Any other disagreement on whether that's the most important thing in valuing a newly licensed entity? Yeah, everyone agrees.
We saw that. Florida's the classic example, right? It's like those licenses continue to escalate. New York, we represented somebody in New York on one of theirs, and the valuation there doubled from the time that the negotiation started till they ended, because currently there's limited and they're all vertical. That'll change obviously over time. So that's the biggest. I'd say for most licenses now, I think what people will do is it'll be much more of a buy versus build type of analysis.
Exactly.
Or something that's usable. So what that means specifically is, if I'm somebody looking to buy the license, how much would it cost me to do the work to get the license, put in my application, maybe have to risk adjust that for not winning the license, and then what other capital would be required to get to the point of a newly licensed business, and get to that point. So I would weigh those two points and come up with whatever valuation that would be. But that's in most jurisdictions where it's not, I'd say, a totally limited license. That's the approach that most will take, and it'll probably be much lower than most people think.
So newly licensed entity, no cash flow yet. That's the end of the story. Anything else to add there?
Well, and I'd say that's for plant touching. If you're looking at kind of a new, license, if you're looking at more of a startup in the non-license, or maybe in certain areas, I know testing, that'll be, again, very dependent on the state regulations around that. Some of those will be slightly different and be much more based on your value, potential, than just purely the license. I'd add that being a little bit different.
We have quite a few questions also on laboratory, valuing not the ancillary businesses necessarily, but the laboratory, the testing, and also like mobile payments. I guess that's an ancillary business. Do any of you do any work in those areas?
I can speak lightly to that. We haven't had any interest in testing facilities or laboratories.
Really? Even though they're in such short supply? I mean, that surprises me, but maybe they're going to be a commodity and that's the prediction?
I think it comes down to scalability and who can come in the market and the things that you can do with a lab. I mean, it's necessary, but what can you do with it? How can you grow that? How can that scale? Maybe you can go to a different state. Maybe you can bring your SOPs to another state and expand the footprint. But when we're talking about scalability and potential for growth, we haven't found a lot of interest in that type of business. Now, ancillary software, of course, they're experiencing, if you come up with a great mobile payments or a great retail operating software, you're going to see great multiples. We've seen it with Dutchy. We've seen it with these phenomenal software companies that can really scale, right?
So and let me stop you right there, because I think it's a great question. If you could finish this sentence, Fernando, you can go first. What would it be? If someone could just invent X that would work really well and better in the cannabis industry, like, give me a call right away. What is there really a need for out there that you think would have huge upside?
I need a minute for that.
Okay. Anyone else? Maybe it wasn't a good question.
It's a great question, but I need just a minute.
Anyone else?
Yeah.
I'll go. I think the biggest area that I see, and I'm kind of working on some formal thoughts on the presentation so people can revisit this later, but I think it's really customer data and anything surrounding customer loyalty, and not just loyalty programs, but really understanding your customers and driving and that's especially, I would even say, more for brands, like actual people in the brand space, and driving that customer loyalty and brand recognition. That is the biggest value, especially in the current environment where most places you really can't advertise much of anywhere, maybe a billboard here and there. But to me, that's the biggest area within technology, software specifically, that I think has the biggest value.
I would agree. I would strongly agree with that. At Grassroots, we made a big push starting in early 2019 to incorporate data and data analytics. And we hired an outside firm to really help us capture the data. It was amazing to our CMO, who came in from Kimberly-Clark, used to run international for Kimberly-Clark. And in a normal CPG business, the amount of data that you can capture is much more limited. And in our instance, we had a tremendous amount of data, but it just wasn't being captured, wasn't being analyzed, wasn't being used to really determine ordering, and customer, incorporating it as part of the entire business and the fabric of the business. And those tools are still very hard to find. And, that's what real businesses, real CPG businesses use. The other piece that I'd maybe highlight is just, things on really tracking yields correctly. You talk to 10 different companies and they all talk about their yields in a different way, grams per square foot, grams per, canopy square feet, pounds per light, all kinds of crazy things. But, just developing those kind of metrics and being able to then dial in the, all the knobs, if you will, for environmental controls, fertilization, all the other things that you use across facilities in order to incorporate best practices and raise yields. That's where everybody's going, and that's where everybody wants to get to.
So math nerds, pay attention. Math nerds who want to learn a lot about cannabis and agriculture, there's opportunity there.
Yeah, data is the way to go. I got a call the other day from somebody, asking me about a payments processing banking, system platform. I mean, I wouldn't spend a minute on stuff like that because, when the regulatory changes start coming through, all that's going to go away. I mean, people will be using Visa cards, and people will have their bank account at Bank of America and JP Morgan. So
something that's unique to the cannabis industry is that's not going to go away with changes in regulatory.
No, that is going to go away. I mean, I
know that's what we should be looking, or what you're looking at as having high potential.
Look, I think the solutions that people are looking for are to integrate the world of cannabis, which started as, a bunch of entrepreneurs and some guys who really came at it from the culture, if you will, into really mainstream data and analytics and management tools that run world-class companies. And, that means, to Jeff's point, you really need, robust data capturing and data analytics and the ability to then make that actionable. There's the old phrase, you can only manage what you can measure. At the end of the day, people didn't have the tools to measure these things.
I've got to bring up something in the chat because I think we're almost out of time, and one of the previous panelists strongly disagrees on the lab testing assessment since all products are mandated to be tested. Even just my 2 cents, looking at hemp, industrial hemp and the uses for hemp are only going to increase. And CBD, the government has admitted there aren't enough hemp testing labs to test to qualify as hemp. So we're going to push that requirement forward. So why not? Couldn't a lab company scale and increase the amount of variables it's testing, and there could be room for innovation there that might drive some value?
Sure, and I like to take on that. I'm just saying that the investor base that we work with in the 4 years that we had a cannabis practice in Young America Capital never inquired about what deals do you have in testing. It's just the reality of what we've seen. I'm not saying that a testing facility is not valuable. For some reason, and I know the reason, investors are looking for different types of deals.
And maybe it's education then, educating investors as to what other options there are.
When we looked at the numbers of testing facilities, they're not that exciting. And when we look holistically at opportunities for scale, for growth, and also, we're talking about state licensed facilities. What's going to happen, as Brian was saying, when those things change, and now, we can have a major lab that has been doing DNA testing that can implement cheaper and better ways with their infrastructure to test for cannabinoids or whatever you're talking about. So not saying it's not valuable. Of course, everything is. Every company, every entrepreneur that gets something going off the ground creates value the minute they do it. Our experience has been people want to look at great assets cultivation. People want to look at brands. People want to look at limited license market operators. But I've never had an inquiry about testing. I don't know, Jeff, Brian, if I'm way too off from what I'm saying.
I'm backing up Fernando on this one. It's plus look at from I was on the operating side for 2 years, and the stories and the real life situations that we experienced where operators would shop testing labs. They'd send out 2 literally 2 samples to 2 different testing labs. One would come back at 18% THC. The other one would come back at 23% THC. Guess which one got the repeat order? I mean, it's a filthy business. It's there's a lot of shady stuff that goes on. Some of the states are trying to clean that up. Hopefully they do. There are reasons why there haven't been a dominant company that's really risen. There are a few different regional firms that I think are doing fine, but the barriers to entry are not, they don't create a moat where it becomes interesting to investors to invest.
Anything else on that, Jeff? You want to get into the mix here?
I'll do the other side. I'll try and be the. I think they can be great businesses. One, they are needed. It is a function that is needed and will be needed in every state. So I think I think some of the reason that you don't get as much investor interest is largely because it's one of those where you actually need. You have to have, degreed people. You have to have real science. It's not, hey, we're selling a gummy, and most of us understand what an edible is or what walking into a retail store is. Understanding the, unique capabilities of a testing lab are hard for myself and most other people who are not lab technicians to really dig in and understand. So that part of the process, I think, keeps a lot of investors away. So from the investor universe, you just limit people who are like, hey, I've got a bunch of decks. I understand the value proposition on this deck. I don't, outside of knowing, like, yes, there's a lot of testing in this. Brian brought up, part of the issue is there is a lot of not, partly bad actors, but also labs that did the right things, and then they're not getting the reorders because they aren't putting THC back when, a little bit more when that was important, when you were just testing THC. You weren't testing hard metals. You weren't testing a lot of the other factors. So I think that's part of it right now is it's just the investor universe isn't there for the reasons I mentioned. I think the concern that you have is, yes, the ability to scale. Steep Hill clearly tried to, do a license type of situation, and that didn't work out. So I think that's brought some trepidation to people entering the market from a lab side. And then I finally just say the unknown is, yes, when it becomes legal, do the 2 or 3 major testing labs, are they able to flip a switch and just roll out testing, wherever they are in a much more efficient manner? And does that, kind of like in technology when people say, what about Google or what about Amazon?
Barbara, real quick.
And we've got to log off in a second, but go ahead, Fernando. 5 seconds.
If you have a testing facility in a business, I love you. Keep doing it. It's very much necessary, but get creative. Go beyond cannabinoids, go beyond terpenes. What else can you tell us that anybody else is not doing? How can you differentiate yourself? Cannabis is a phenomenal plant with so many compounds, and we're just looking at a few of them. So if you're a testing lab and you want to have a big multiple, if you want to be interesting for investors, do something different. What else are you looking at in the plant? What else are you looking at? Different types of things that we can find on the plant. If you're doing the same thing that everybody else is doing, cannabinoids, terpenes, and such, you're one of the few. You're one of the many. You're one of the pool. Do something different.
And now I'm seeing a little more of the difference between the valuation folks and the VC folks who are in the chat. VC folks, it sounds like opportunity to them. Valuation folks, we're not going to project an imaginary revenue stream, not at least at this point in time. So I think there are going to be some discussions maybe about that after this panel. Bradley's telling me we have to end this. As much fun as this has been, thank you, everybody. Once again, I want to thank our sponsors, Michael Best, Verta Innovations, Seed to Sale Funding, Cannabis Facility Construction, Illinois Equity Staffing, and MGO LLP. So thanks for watching, everyone, and don't forget to check out growing.com/summit-learning for documents and links. It's been a pleasure, gentlemen. Have a good day.
Barbara.
Thank you, everybody. Thank you, Barbara.
Bye. Thanks, everybody. Be safe.
How do I stop the broadcast?
I still see myself on screen. I don't know if you see yourself, Jeff and Brian.
I think we just shut down I think we just shut down the browser, and that'll.
Guys, great to participate with you. On point on most of the things. So thank you. It's a learning experience for me as well as a young gun in the industry. But thank you so much.
Yeah.
Sure, guys.
Thanks, guys.